Hello, this is Stacy Francis from Francis Financial. I'm the president and CEO of Francis Financial. Francis Financial is a wealth management boutique, and we are specializing in overall comprehensive wealth management for individuals and successful families. Today we're going to talk a little bit about the third quarter, which had lots of bumps, ups and downs, as you all know, and also a outlook towards 2015 and beyond. So there's a lot of great information that we're going to go through. If you have specific questions also, feel free to use the chat bar that you see there on the left, and as time permits, we'll make sure that we get through each piece of them. So let's go ahead and move forward, and I'm going to talk a little bit about our quarterly review, what happened this last quarter. Secondly, we're going to look at our investment outlook, and then finally, the portfolio positioning. So what the positioning we have now to really set us up for success going forward over the next couple years. So with this, let's jump into our quarterly review. It was quite a quarter. In fact, U.S. large cap stocks, they did manage a gain, but it was a small gain. In fact, U.S. stocks, those smaller cap stocks, they actually declined. So again, large caps came up just a little bit, and smaller cap stocks actually declined. The U.S. continued a path of modest economic recovery, and so far has been able to withstand quite a bit of uncertainty related to monetary policy as well as geopolitical risk. As you know, if you're watching CNBC or any of the other programs out there, it's been an extremely volatile time geopolitically across the globe. Developed international stocks didn't fare so well. In fact, they declined overall during the quarter as Europe continues to face an uphill battle. Some individuals were hearing whispers of actually them falling back into a recession, potential deflation fears as well. We've got more about developed international stocks that we'll talk about, but this is an area that we're definitely watching, making sure that they're continuing on the path to recovery. We've seen a lot of geopolitical tensions, in particular, as you've seen, Middle East, Russia, Ukraine, Hong Kong, particularly as the quarter ended there with protests. And these, unfortunately, were all negative for emerging market stocks. So the positive on emerging market stocks is that they look even more valuable today than they did a quarter ago, and do offer a lot of positive upside. But our negative is that, unfortunately, they had a difficult quarter facing an uphill battle against all of this very, very disturbing news. As far as core bonds were actually flat for the quarter. However, interestingly enough, bonds were remaining positive. We look at year to date, they've had a really nice hefty 4% return, which is quite a nice return for bonds in face of typically an asset class that has very, very moderate growth. You can see over here to your right, we have put together a wonderful chart for you, both showing you all these different asset classes, the quarter return, and also year to date. And what we're going to do is I'm going to show you a wonderful chart here that shows you for equities, for stocks, what has happened both in the third quarter but also year to date. We have those mega caps. These are the largest of the large cap, large company stocks. And you can see that the third quarter, they posted the most positive gains of any segment of U.S. domestic stocks. In fact, it was over a 2% gain. If we look at the year-to-date gain for them, it was a hefty 8% plus gain. Now, large company stocks didn't post as fair or positive numbers for the quarter. In fact, it was quite moderate, just nearly about a 1% gain. However, for the year, they're at about 8%. And then finally, we have our mid-cap and our smaller company stocks. Mid-caps actually were negative for the quarter, almost a 2% loss. And for small company stocks, they actually were very, very, very negative, closer to a 7% loss. Now, as you all know, we have actually underweighted small company stocks as well as mid-company stocks in all of our portfolio. So for us, this was a net-net positive, and our clients were definitely breathing a sigh of relief when they looked at their portfolio and saw that the small company stock exposure they have is quite minimal, and they didn't to sustain many of the losses that many of your counterparts might have over this last quarter. And why is this happening? Well, we continue to have a path of recovery, but the U.S. economy has had a slow path of recovery that has been following the financial crisis. And this is a wonderful chart, and it shows you the six last expansions compared to real GDP, gross domestic product. And overall, you can see that our current expansion, which is that wonderful blue line that follows starting from September 2007 all the way to our most recent numbers here, that our expansion has been much more of a slower expansion than what we've seen previously. And other expansions have been much more robust. That of 1982 really peaking out as the most robust recovery. Now, why is this information important? It's important because the overall growth of the economy, or GDP, is very much a very big factor with regards to how you need to plan for your portfolio and the success or the growth of your portfolio, what you can expect going forward. They are definitely correlated. And so let's talk a little bit more about the investment outlook. So the investment outlook that you can see here, we have large company stocks in the bull case actually doing quite well. And that bull case, however, is not a scenario that we give a lot of weight to. In fact, the scenario that we believe is the most likely to occur and what we've actually seen over the last several quarters is that of our base case scenario. That base case scenario shows moderate economic recovery, that it continues without any major type of crisis. But however, GDP growth and interest rates, we expect them to normalize over the end of the 5-year horizon. So with that, we see that going forward, the types of returns that we've seen over the last couple years, particularly in stocks, is quite significant. And with that, we don't expect returns of that same amount or that same large, kind of nosebleed levels going forward. The other thing I do want to talk about is I do want to talk about the bear case, because this of all the pieces or the types of recoveries, this is the one that really sends the biggest fears, the biggest chills into individuals that are our clients, and that would be the fear that the economy actually falls back into a recession, and this could be for a very large number of reasons, such as deflation, deleveraging from Europe or China, a potential unexpected seismic shock, potentially a Fed policy error, something that's not currently priced into the market. However, I do want to tell you that when we say the bear case, we don't assume that it's going to be as severe as what we saw in the financial crisis, and that is the time period from 2008 through 2009. To give you all some comfort, some peace of mind, we do not see the bear case as anything to be concerned about. It's essentially the model we think is least likely to occur. Instead, we expect more of what we call our base case, not only for this year, but also for going forward. So let's move forward with that. So here we have, as far as our going forward with European stocks, they actually look extremely attractive compared to U.S. large company stocks. And with this, you can see that we put together a wonderful chart for you showing you the different asset class returns that we would expect for, in blue, this shows you large company stocks here in the U.S., and then in red, developed international, or you could also call it Europe. So this chart gives you a very clear picture on what are expected returns in each of these different asset classes going forward based on the different scenarios. So as we mentioned in the last slide, we have an expectation more of a base case scenario moving forward. And you'll see that the expected return for U.S. stocks is quite minimal, a 3% return each year. Now, however, for developed international, it's much higher, and it's actually bordering on essentially almost a 10% return. So one of the questions you may have is why would you not add some of your exposure to large company U.S. stocks and put that over more so into international stocks? And our answer is, well, that's exactly what we have done. And what's unique to where we are today is that Francis Financial, for the first time in the 12 years that we've been doing this work, that we have seen that the ratio to large U.S. company stocks compared to international stocks is the closest it's ever been in, again, our 12-year history. And because we have done that, we're seeing that going forward that the expected returns for our clients are much higher. Because, again, the expected returns for European stocks relative to U.S. stocks are much higher across all the scenarios. Not only that base case scenario, but also the bullish case scenario. And let's look at that bullish case scenario, because I don't know about you, but I'm sure that that's really what you dream and hope would happen to the economy going forward. And with that, you would see that large company stocks, U.S. stocks, will do well in that bullish scenario, almost a 10% return annualized each year over the next 5 years. But look at the returns of that international, that developed international exposure. You're looking at returns well above, well north of 15%. Where are we going to end up? We all wish we had a crystal ball, but for us, we're looking at the base case scenario to be conservative and to make sure we're protecting our portfolios. But again, we're hoping that as good economic news continues to be released, that we start to edge closer to that bullish scenario. So take a look at this. Talks about our asset class returns over the next 5 years. I know a lot of individuals are interested, what's the asset class expected returns for the next quarter, but I will tell you that we don't have a crystal ball, nor have I met anyone else that really has a crystal ball and is able to name the type of return to expect at each one of these asset classes with any type of certainty, with clarity, or any type of accuracy. Instead, it's much more accurate to look out over a 5-year time horizon, and we're much more confident in our scenarios going forward and the estimated returns for each one of these asset classes. So based on each of these, based on this chart, what we're looking at is the estimated return of these asset classes on the left and the risk, and you can see risk along the bottom. We're going to start off at the most risky assets. You can see these out here, emerging market stocks, and the type of return we expect and for a base case return is closer to about a 12 or 13% return. For European stocks, as we mentioned in that previous chart, that's about a 10%, and for U.S. stocks, probably about a 3%. We have some on the left-hand side. We have our alternative strategies. We also have our fixed income or bond holdings, and you can see that from bonds we expect from floating rates about a 5% return. Alternative strategies about 5%, and then we've got our absolute-oriented fixed income strategies closer to about a 4%, and then finally investment-grade bonds closer to a 2% rate of return. So this gives you again an idea of going forward. The types of returns we expect from all of these different asset classes. These are our big picture considerations. Monetary policy continues to influence our financial markets. In the U.S., the timing and pace of rate hikes actually remains a big unknown. And so with that, it's very hard to actually time the market of when to shift assets from bonds into stocks. Instead, what we've done, and we'll go over this in the future here as we talk a little bit later today, we've made sure that the fixed income exposure that we do have is less sensitive to interest rates. And we'll explain more about why that is important, but it is something that you do need to make sure that your portfolio is also set up to deal with. There is definitely some positive news. For example, the labor market and wage growth are key to the Fed's assessment of overall economic health, and both actually both are starting to lag a little bit other than economic recoveries, but they are on the right path. Debt deleveraging has progressed nicely. That's a fancy way of saying that the average consumer, you and I, we have done a phenomenal job of paying off our debt. So we've paid down credit card debt, mortgages, and we're in a much more sound financial situation that we've been since essentially 2009. Valuation for stocks do remain somewhat elevated. We are somewhat underweighted to U.S. stocks. That has benefited our portfolios handsomely over this last quarter when U.S. stocks did not perform very well. And we are going to continue this stance of having a little bit less exposure to U.S. stocks, partially because of the current valuations where U.S. stocks are, and we're just concerned that they're somewhat elevated. The central bank in Europe and China are continuing to remain active in trying to boost growth, avoid deflation, and make sure that those parts of the world continue on their economic recovery. So with that, we are definitely pleased by that it looks like they're willing to do pretty much anything they can to keep them on the road. So let's talk a little bit about the labor market. The labor market is continuing to improve, but unfortunately, the recovery has been much slower than what we've typically seen in other economic recoveries. So what we've done here on this chart for you is that we've looked at the gray line showing the average 6 last expansions over the going back to 2007. We have then our current. So we have from 2007, this is the current, the recession, and then our recovery right here with regards to our labor market. And then here we have just overlaid on top of that the average of the 6 last expansions. So while we have definitely pulled ourselves out of some of those very negative labor market numbers, overall we still are lagging versus the 6 last expansions. So essentially it means that we've got more work to do, and there's definitely significant underutilization of labor resources. That means that there are many individuals that would like to be working full-time, but they're having to work part-time. There are individuals that have been forced into retirement not because they want to, but because they've been laid off and they can't find another position. So these are all things that we definitely look at and are concerned about and watch very, very closely going forward. As far as wage recovery, rising wages for your typical worker, your typical employee, is actually extremely healthy for the economy. However, it could have a negative knock-on effect. It could have negative implications for profit margins and earnings growth for businesses. And so what we've done here is we've shown you 2 really important data points. And the first is wage salary disbursements. So this is the current wages of individuals, and then we have the corporate after-tax profit. And interestingly enough, as you can see from 2009 and to present, that there's been a lot of pressure on wages down. The typical employee is making less money as a percentage of gross domestic product than they were in 2009, and definitely a lot less than they were earlier in 2003. So that means that the average consumer versus growth of the economy is making less money. Now, there has been an uptick. In fact, more recently, over the last year, you can see there's kind of a nice uptick. But that also means that will impact potentially weighing on businesses having to shoulder the increased cost of employees. There's a lot more to go. We're still definitely, the average employee has depressed wages versus where we used to be, but overall we're on the right path. So this is deleveraging, as I had mentioned. This shows you household debt as a percentage of personal income and household debt as a percent of GDP. Essentially, what this key metric shows you is that its debt to income is back in line with the long-term trend. It's a positive indicator of the willingness of consumers to pay off debt. And today, consumers have much more sound financial positions, and they're able to actually increase their spending. They're actually able to increase their borrowing in a way that is actually healthy for them. And going forward, talking about stocks, the rally in U.S. stocks is actually outpacing earnings growth. And if you take a look at this chart, this is the rationale between where we say that stocks are trading at elevated levels. Here we include the S&P 500 trailing 12 months earnings per share. It essentially shows you the earnings per share of the companies in the S&P 500. It's one indicator of profitability of those firms. And then on the gray line, it shows you actually the S&P 500 index and where it's trading. Over time, what we've seen is that the profitability of these firms is somewhat correlated to the price and the earnings of and the growth of the S&P 500. You would actually expect that as companies become more profitable, they show higher earnings growth, that you would expect potentially that their stock price increase. And guess what? That has been the case. But look at what's happened over these last several years. We've seen that come December 2012, that yes, we have continued to have increased earnings per share, increased profitability, but look at what the S&P 500 has done. It has skyrocketed forward much beyond, further than the actual earnings per share. So essentially, what we're seeing is that the rally that we've seen in U.S. stocks is actually outpacing earnings growth. This is what causes us to pause, and part of the reason why we are somewhat underweighted in large company stocks, because it's much higher for the S&P 500 to continue this feverish nosebleed pace upwards where we are today than versus where we started back here in 2009. It's much harder to see those huge growth rates going forward than what we've seen in the past. Again, it doesn't mean that we expect a bear case scenario or going back necessarily into a long-term recession. It just means that we don't expect as high returns over the next 5 years. Now, small company stocks, we had spoken about a little bit before, they remain overvalued. We have, on purpose, had less exposure to small company stocks over these last several years, but the gap is starting to shrink. And the only reason why the gap has started to shrink and that small company stocks are starting to come in line with where they should actually be priced is because, well, they've lost money. So let's take a look at this chart. We have the earnings per share, the premium for small company stocks. This is the average for small company stocks. And here we have in our blue section, it's the small cap PE ratio. And so essentially what we're showing is that we are somewhat overvalued versus the average, but the space between these, because small company stocks dropped in value so significantly over this last quarter, they're still not back in line, but they're slowly going closer to being back in line. So what does this mean? This means that for us, we still do not believe that we should put more money into small company stocks. We believe that there's more money to lose in small company stocks, and it's not a place where we believe our clients should be. The next piece is really looking at the private sector balance sheets. This is people like you, people like me, and this is also really good news. As we've done a great job paying down our debt, it's helped our balance sheets look a whole lot better. And why is that important? It's important because of this. Look at what happened to our net worth after 2008. It took a massive drop, and you can see that over time our net worth has slowly increased. It's increased because we've paid off debt. Our homes have gone up in value, and also the stock market has been our friend, and our stock market has also increased. So this all adds up to $81.5 trillion in second in the second quarter that we've posted. It's a record high for net worth, and it's up 10% from a year ago. When we look at economic indicators, this is just another piece that we look at of what we consider to be very important and predicting and trying to create diversified portfolios going forward. Portfolio positioning. I've talked a lot about that in the context of the last couple slides of based on small company stocks being overvalued, that we are underweighted, that also large company stocks being overvalued, that we are somewhat underweighted. Emerging markets, we are in line and have a little bit more exposure to emerging markets than we have had previously in the past over the last 5 years. And the same is true from actually developed international. That's countries like Canada, Europe. So with that, our portfolio positioning is really important because it's the main driver of investment results. Your asset allocation is the main driver of your investment results. In fact, 94% of your returns in your portfolio are based on how much you have in large company stocks versus small company stocks versus international stocks versus the different types of bonds we use. That is 95% of your performance. The other 6% is other factors. Factors like choosing the perfect hot stock. Another factor would be putting your money in at the exact right day and pulling it out the day before the market goes down, which I don't know about you, but there are very few people that can really do that ongoing in any type of accurate way. So what's nice about this is that you have the power to know that the vast majority of your return is based on you and based on the asset allocation that you choose with your investment advisor. And we very much try to focus on what we know with a reasonable degree of certainty. That's why, again, when we look at the future, we're looking at the 5-year return expectation for asset classes. Nowhere near in this presentation today have you in any way had me explain to you what the return for next quarter will be. Because guess what? That's something that we don't know. Instead, we look at 5-year time horizons and looking at how to diversify the portfolio to make sure that you are protected from the risks that we see and we know are going to occur, but at the same time have exposure to certain areas that we also feel confident are going to do well over the next several years. As I mentioned, our equity allocation is slightly tilted towards foreign stocks. In fact, one of the reasons is because of the expected return, particularly from emerging markets. What's interesting is that the overall growth of the world, or the world growth GDP, 50% of that growth is being fueled by emerging market countries. However, only 11% of global market cap is actually due to emerging markets. And we believe that the discrepancy is going to actually continue significantly as emerging markets continue to improve over the long term. On top of that, emerging market demographics are extremely favorable. There are many different factors, but one of the most important, in my opinion, is that emerging market countries have relatively young populations and very much an investment in education. So we're seeing that emerging markets, those type of countries, have vast pools of very smart, talented individuals that are driving the economies forward. Whereas we look at the U.S. economy, and we're in a different situation. The U.S. economy, we have more of an aging population. These individuals are leading to higher productivity in emerging market countries. Per capita income is also increasing. We're seeing more middle class and upper class individuals, spurring them to continue to be successful, creating higher growth rates. And so higher growth rates we're seeing for higher growth of companies, and the only piece is that it's part of being patient, that we may not see as higher stock prices in the immediate near term, but we know that long term it's going to be very, very positive for those investors that are patient and are going to have the time to devote to having that international exposure, particularly emerging markets. So as you can see here, this is the global share of GDP. Emerging markets, they are fueling 50% of the overall global growth, but the actual market cap, the market cap of the companies trading on the market for emerging markets is only 10%. So that's where you can see there's just an unbelievable amount of growth, and it's an extremely exciting period. Now, one of the pieces also in our positioning I wanted to share with you is this chart, and it's very important that that you think about bonds, making sure that you are protecting your overall positioning from Fed rate hikes. In our base case scenario, we assume that interest rates are going to move higher over the next 5 years. These are interest rates. And so because of this, we have made sure that more than half of our exposure in our more moderate portfolios, it has very little impact by interest rate rises. And so with that, you can see this chart shows you the interest rate sensitivity of certain investments. And here you can see over here on the least sensitive part of the presentation, the least sensitive part of the chart, you can see wonderful exposure. BlackRock floating rate, we have FPA new income, we have T. Rowe Price floating rate, and Osterweiss strategic income. So these are all holdings that we think very highly of and that are in our portfolios. And then you can see to the right, having more interest rate sensitivity, we have a few other holdings, Double Line Total Return, Loomis Sales Bond, and then also we have here to show you the indexes. We're not currently invested in these indexes, but these show you the sensitivity. So interestingly enough, the index, such as the Vanguard Bond Market Index, is one of the most sensitive investments to interest rates. And so what that means is that as interest rates continue to go up, you're going to see that the prices of these investments goes down. And that's a fancy way of saying that you're going to lose money. So what does this mean to you? This means that you need to make sure that you look at your portfolio, that you take the time to really understand how sensitive are your bonds. This is very important because overall, it's not just having bonds to diversify your portfolio. It's also making sure that within the bond holdings that you have, that you also have diversification among the different types of bonds you hold. And that means having short-term bonds, long-term bonds, having floating rate bonds, having other types of bonds as well. This is all very important. So today we've gone through a lot of information. And again, as a recap, what we've done is we've gone through and shown you everything about what happened during the third quarter, what we expect going forward, and really important factors to consider, and also our portfolio positioning. We're also getting a couple questions in, and so we've got a few more minutes. We've got about 4 or 5 more minutes, so I'd love to make sure that we can have some time to really focus on those. One of these questions, I think it's a really smart question, and the question is, why was the decision to sell PIMCO Total Return and PIMCO Unconstrained so clear-cut when you had so much confidence in PIMCO as a firm after you recently did a big deep dive research process on them? So those of you on the call that are not current clients of ours, we recently sold all of our holdings in the PIMCO family of funds. This was in response to the extremely abrupt and disturbing departure of Bill Gross. Bill Gross had been with PIMCO for 45 years, actually helped found the company, and is one of the top bond managers in the world. His departure was quite abrupt, and in no way does this make us lose any confidence in the remaining investment team that still stays and spearheads the ship at PIMCO. However, because the departure was so sudden, we are concerned about the ongoing long-term fundamentals for this team. In particular, we are concerned that Bill Gross's departure may not be the last departure that we see over the coming months and potentially coming years at PIMCO. In addition, we were very confident, and this has been definitely something that we've seen, is that we expected millions upon millions of dollars to flow out of PIMCO, making the job of the investment committee to manage the remaining money within PIMCO Total Return and PIMCO Unconstrained much more difficult. We saw this as a net negative for our clients, and as such did not want to expose them further. So with that, we are continuing our investment research. We have already invested the money from our PIMCO Total Return into a wonderful fund alternative, and we are at the final parts of our research on the PIMCO Unconstrained. We expect to actually have the finalization of our research in the next couple weeks, at the very latest at the end of November. And so with this, we have, I think, a much better portfolio where we are today versus the day that Bill Gross went and made this announcement. So I also have another question coming in. I think that this is a really interesting thing. A question about Francis Financial. Is Francis Financial being overly cautious by having underweighting in U.S. large company stocks? Is this something that we are being too cautious? It's a great question. And I will tell you that our overall investment philosophy is one that we expect in a market, a bull market, where you're seeing nosebleed levels of stock returns. We very much expect to underperform during those time periods. However, during times of large losses, like we actually have seen recently, you'll see that our portfolios actually outperform and do much better. Essentially, we manage our portfolios to downside risk, trying to protect from that downside risk. Our clients, majority, they like to see nice returns, but more importantly, they don't want to see large losses in their portfolio. So with that, we definitely have more of a cautious approach to our overall investment, but it's something that our clients feel very comfortable with, and they feel that they are getting great value, and the softening of the bumps, of the up and down of the roller coaster, is something that is extremely important to them as they start to really think about their goals and making sure that they get there over a long period of time. Another question is essentially about the difference in expected returns from U.S. and developed and emerging market stocks, and is this a time where we should even overweight more so and take more money from large company stocks and put them into emerging market stocks as well as developed international? And it is a good question. And for us, our response to that is less so about, do we throw all of our eggs into one basket? It's more about thinking about the risk of the portfolio. Every portfolio that we manage has a risk-loss threshold. This is a fancy way of saying that in any 12 months, that portfolio should not lose more than 5%, 10%, 15%, or even 2%, depending on the type of portfolio, if it's a more conservative portfolio or if it's a more aggressive portfolio. So with that in line, and that being part of our commitment to our clients, our investment policy statement with our clients, we do everything we can to manage that portfolio to make sure that there's not so much risk that it could actually go through that type of a loss in the event of a very major downturn. So while it would be great to invest more money in emerging markets and also developed international, those two pieces, those two asset classes have much more significant risk than the risk we see in large company stocks. So that's something that we're already over allocated in them, and it's not something that we're expecting to do more of going forward. Great, we have another question coming in. Okay, so this is a question from someone does not look like they work with us, but they say, if they're interested in working with Francis Financial, what is the best way to find out more about our investment philosophy, how we work with clients, and help them reach their goals? It's a great question. It's a really great question. We have a very, very detailed process that we take clients through to better understand what their concerns are, what's important to them, and what their goals are. And then we map out a detailed roadmap that helps them understand and gives us clear deliverables on the action steps we can take to achieve those goals. One of the most important pieces of achieving those goals is making sure that they have an investment portfolio that is allocated properly for them, that is invested in a way that they know that over time they will get to that early retirement that they might be looking for, or sometimes it's also looking and making sure that we're funding education costs, making sure that we have money for a second home. These are all very, very important goals that many of our clients have, and creating a portfolio that we know is going to help them get there is definitely a very key piece of part of that process. If you are interested, feel free to reach out to us. In fact, you can see I included a chart here, a little page here. You can reach us at Stacy@francisfinancial.com. We've given you our office number, and also feel free to check out our website. We've got a lot of great content on the website that would be very helpful for you. So we're coming up to 12:45, and I just want to honor everybody's time and thank everyone for being here on the call. If you have any questions, please do reach out. We also offer what's called a second opinion service, and it's something that we offer to our clients as well as trusted colleagues of ours or individuals that actually are on the call today can have this available to them, where we will look at your portfolio and give you smart, actionable, interesting information about how you can make changes to portfolio to make sure that it's as robust towards reaching your goals as possible. So if you are interested in that second opinion service, please do reach out. There is no charge with that, and it's our way of trying to help other people, because ultimately what it comes down to, according to the Wall Street Journal, essentially 8 out of 10 individuals would appreciate a second opinion about their investment portfolio. And so with news like that, we know that this is something that's very much needed, very much appreciated, and we'd love to be able to help out you or some of your friends and family. So with that, thank you for your time today. We will definitely have this recording up and available on our website. And again, if you have any questions, feel free to reach out to Francis Financial. Have a great day. Thank you.